Yeah, so everybody is welcome to ask questions, maybe make comments as we go along. And yeah, so tonight we've got special guest Sanjay. So yeah, thank you for joining us. And yeah, Sanjay is going to be speaking. We title this, or I title this, "The Ins and Outs of Property Finance." But I actually asked Sanjay to prepare three specific topics. And I just need to remember what they are. One of them is basically how finance works for BRR projects. And then I asked him to speak, yeah, specifically about second charge mortgages and a specific product which is called yeah, bridge to let. So I'm going to hand over to Sanjay if you'd like to start. But yeah, please, anyone with questions, ask as we go along. And after the presentation, we'll have more questions and we'll look at two or three practical examples to see how finance could work on those examples. And if people have questions, then yeah, feel free to ask them.
Wonderful. Thank you, Trevor. First of all, I don't use Zoom all the time. I love my Teams and my Google Meet. Can you guys hear me okay and see my desktop?
Yeah, we can see you. Yeah, we can see that. Yeah.
That's fine. Okay. Every time I use Zoom, something always goes wrong.
Yeah.
And Trevor,
You
thank you
might
for the
be able to
opportunity.
switch your desktop so it's only showing the slide and not everything around it.
Okay. Let me just try that.
It's not critical, but we'll be
Yeah.
able to like sort of zoom in more.
Is that better? Can you guys hear me?
That's perfect. Yes.
Yeah, perfect. Yeah. And also, Trevor, thank you for the opportunity. Tuesdays is always tough. I normally play badminton on a Tuesdays at my club. So I had to kind of pull out the match today, but I'm more than happy to present. So it's a good opportunity for me to meet you guys and to also kind of, enhance your understanding of finance. So Trevor, thank you for the opportunity. So the purpose of this is that I've got a few slides I want to go through about property finance. I'll assume for the purposes of this presentation that everyone over here are novices. If I am repeating anything which you guys know, please accept my apologies, but it's always useful to kind of go through things at a very basic level. And if you have any questions, please do ask. I think the purpose of this session is to impart some knowledge to get you guys prepared with any decision making that you need on property and finance. And whatever you need, please do ask on there. That's the whole purpose.
Yeah, and what we're going to be doing as well is because people are from time to time asking us to find them BRR projects and things like that,
Sure.
and they're asking how the finance works. So we're going to yeah, have this presentation available, which might in fact save you a few questions, Sanjay.
Yeah, absolutely. I'll share this with you, Trevor, and then we can just get it out to
Yeah.
anyone who needs a copy. Good. So what I want to do is probably go through 5 items on this presentation. A quick intro about me on the next slide. I want to cover off some key definitions of terminology with anything to do with finance. There's a whole array of acronyms and words. They can be confusing, so I'll just go through the key ones. I want to then go through some core topics around BRR. So the types of funding which are available for bridging loan, second charge, and the different mortgage products. And at the end, what I will then do is to cover off the high-level application steps needed when you submit an application, and also to go through some of the key success criteria. With any process, you will be hit by blockers, by things that can go wrong. And what I want to explain at the end are things which you can do pragmatically to ensure that if you do put an application in, these are the basic checks that you need to make before the full application goes through. And as I mentioned previously, if there's any questions that you guys have, yeah, please jump in, or you can wait towards the end. I'm pretty flexible anyway on there. So a bit about me, Sanjay Majithia. I'm a UK FCA registered commercial finance broker, and the company which I work with is finances.house. That's the name of the company and the website. So if you go on to www.finances.house, you'll see a brand, you'll see a sexy picture of me, and a list of the products and the services that we provide. I am based in Leicestershire, but I serve clients around the UK other than Northern Ireland. There's a team of 3 of us. Myself as Sanjay, not as a broker, I've got 20 years plus experience as a portfolio landlord. So I've purchased properties, I've developed properties, I've flipped properties, and I'm still actively going in and out the market with my family on there. So as a landlord and a developer, I've been there, done it, got the tattoo, got the t-shirts, and yet been through the whole ups and downs as a landlord. As a broker, putting my broker hat on, I work with over 200 lenders to secure business and property finance. And out those 200 lenders, which are based in the UK, a lot of those provide me funding for property. And these include high street lenders. So by high street, that could be your Barclays, your NatWest, and your Santanders. I also work with smaller lenders, which we call tier 2 and tier 3. So there's a number of lenders which came in after the 2008 banking crisis, which are called challenger banks. So a lot of these banks are now challenging the high street lenders, and they probably have a higher volume of transactions that they perform for investors. And I also work with smaller lenders, and these are the tier 3 lenders. And this is a mix of fintech companies and specialist lenders, which may deal with either HMOs or applicants with a very severe credit record or any particular asset classes on there. In terms of the types of cases that we work on, I'll just quickly go through this. I don't want to spend too much time on there. I work on first charge bridging cases. I'm doing one at the moment for a property in London, which is around 575. Again, working on other buy-to-lets, a bridging loan for a auction purchase, which is about 260. I'm also working on a number of buy-to-let mortgages and commercial mortgages. One's for a bond conversion, which is in progress at the moment for 700k. And I'm also working on a second charge bridge for semi-commercial property portfolio, where the actual applicant wants to pull money from his current portfolio and to use that second charge to then develop some farm outbuildings to convert them into light industrial units. So as a broker, I work with all types of cases, and I think that's the fun of the market. You can get anything in the morning, but there is a good selection of lenders to go to, which is key. A bit about the small print. I am a broker, not a lender, which is important. I've got my FCA registration number on there, just to show that I've got the right credentials, and my contact details are also on this slide, which can be shared afterwards. Okay, so I mentioned in the very beginning, before I go into any detail, it's important to clear some of the acronyms in terms of reference. I'll just kind of hover through some of the key ones. BBR, which is what we're here for, stands for Buy, Refurbishment, Refinance. A bridging loan, it's a type of finance in the property world, which is usually short-term loans, and it can be up to 12 months. And in most cases, bridging loans can be completed within 1 to 4 weeks on there, depending on the lender. There's also refurb to let, or similar to buy to let. This is an alternative to a bridging loan, where the rates are a lot lower, but the completion on a refurb to let can be anything between 6 to 8 weeks. Again, it's horses for courses. When you are looking at a bridging loan, it may be quicker for an auction purchase. If you are negotiating with a vendor and you have up to 8 weeks to complete, it's always then worthwhile looking at refurb to let and other types of similar products on there. With any lending application, when you go to a lender, they will quote you an arrangement fee, which is what it is. And the other key terms are things like LTV, which is a percentage of the property's value that the lender will be looking to finance. That's usually based on the purchase price, but never the GDV. And other things which are important are things like the exit strategy, which is a key term. When you go to any lender for bridging, they will want to know how you're going to be exiting the bridge and what will you do with the property afterwards. Will you be flipping, or will you be refinancing it to a higher value? And final two key terms are first charge loan, where the lender will take first dibs on the property because it's unencumbered and it's going to be financed for the first time, so they have first dibs on the loan. Second charge loan is where there's another lender already on the deeds who's got one commitment on the property already, a security, and the second lender then comes in to refinance another portion on there. And this could be things like a buy-to-let mortgage or a resi mortgage. So these are the key terms of reference. I will kind of use these as I'm going along. If you're not sure, please shout on there. Okay, so we're all here at the moment because Trevor's probably explained the strategy of BRR, and I think a lot of you are probably in different phases of your investment journey or looking for a property. But essentially, BRR, just as a definition, so we're all on the same page, it involves purchasing a property at below market value. Once it's been purchased, the investor, which is you guys, you will do some value add to that property, and that value add will uplift the property's value to something which is a lot better than it was purchased at on there. As part of that refurbishment, once you've done the refurb, you may then choose to refinance, and you may choose to refinance to keep the property on your portfolio. And that refinancing would then be based on the uplifted value, what we call the GDV, the gross development value on there. And this method is quite common in the market for a lot of experienced and new investors. And it's a cycle which, most people use. In some cases, the BR may become BR, where you make exits the property and flip the property around and sell it on there. So there are a few variations, but in most cases, it will be BRR on there. And when you do look at BRR, you can go on Google and you will see a whole myriad of definitions and products available, including bridging loans, buy-to-let mortgages, refurb to let. These are available, but these are all subject to credit and underwriting, which I will cover off on there. I'm at the halfway point of the presentation. Has anyone got any questions so far before I move over to some of the scenarios? Okay, I think Trevor's silence is a good thing. I'll carry on. So the first one which I've got on the slide is the concept of a bridge to let loan or a bridging loan on there. Now, I mentioned on the definition slide that a bridging loan is purely a investment, a finance product, which is short term. It's anything up to 12 months. And it's more suitable for the situation where you want to complete your purchase at speed. So you may go to an auction, you may negotiate a price with the vendor, and as part of that purchase negotiation, or the purchase you win at the auction, you may have up to 28 days, for example, to complete your purchase. So in those situations, a bridging loan is suitable on there. The bridging loan will also have two elements with some lenders. Some lenders will just give you the bridging loan for the purchase. Some lenders will also give you the bridging loan as part of the purchase, and they'll give you a separate tranche of money for the renovation and the refurbishment on there. So a lot of lenders provide both. Some lenders may only just lend you for the portion where you want to purchase the property on there. This method of purchasing is quick and flexible. And as I said, it's suitable for things like auction purchases or where you're purchasing off market. And the key thing over here is that if you have a property which needs immediate attention and you're willing to pay the additional cost of lending and the borrowing rates, and you know that you can probably flip it around or turn it over to add value, this solution would make sense. Now, with any bridging lender, they will quote a rate for you because you pay per month. Most cases, a bridging arrangement would be for a minimum of 3 months, a maximum of 12 months. But what's important with any bridging arrangement is that the lender will want to know what will you be doing before, as part of exiting the loan. So when you put the application in, they will want to know what your exit strategy is, and they will want to see evidence that your exit strategy can be pulled off, which is vitally important. As you can see on the final bullet point, the rates are usually expensive. So when you're paying anything between 0.7% a month to 1.50, when you multiply that over 12 months and then add on your arrangement fees, it can be expensive. It will be anything above 12% onwards in most cases. So when looking at bridging, to just be aware that it can be costly. The advantage of bridging is a couple of things. Some lenders will allow you to pay the actual monthly commitment on a monthly basis, which is called service payments. Some bridging lenders will actually say, look, what you can do is to settle your loan at the very end of your project on there when you exit. So it is quite common for lenders to quote service repayments. And in some cases, you can actually settle the amount that you owe on month 11 of month 12, for example, and pay at the very end. The advantages of this are things around cash flow, because most investors and developers want to keep their cash rolling in for refurbishment costs. and for other things without paying monthly commitments to the bridging loan. So that's just a couple of advantages of where a bridging loan may be beneficial on there.
Could I maybe add a couple of things, and
Of
you
course,
could
yes.
maybe comment on that,
Yeah.
Sanjay? There are some types of property
Mm.
where the only type of loan that we can get is a bridging loan. So if a property is, we often hear the term unmortgageable. So
Yeah,
that can be a property that, for example, we can't let straight away because it doesn't have a kitchen or a bathroom,
yeah,
or it's derelict, or it might be a property that's got a short lease. So most lenders won't lend on that.
correct, yes, sir.
In that case, we have to use bridge, and then obviously do the changes. So if it's the case of like doesn't have a kitchen and bathroom, we do the renovation and get it into lettable condition, and then we can exit the bridge. Or in the case of, for example, short lease or other sometimes strange things, yeah, also have to get onto a normal long lease to be able to exit the bridge.
Yeah.
That was the first comment. And the second comment, because people often ask this question, do we have to pay 12 months interest on the bridge? Generally, when we get into a bridge, it's like a race. So
Yeah.
we're trying to do everything to get out of the bridge as fast as possible. And generally, most lenders, there's a minimum of 3 months interest. So if you complete in 2 months, I mean, that's most unlikely, then you still have to pay the third month. But any time after the third month, if you're able to exit the bridge, either by selling or
Mm.
refinancing, then you only pay the interest for the months where you had the
What it accrued.
bridge. So you might be planning to, on a project, to be paying 20 or 30,000 finance costs on a bridge. And if you can do it fast, you can reduce that to 15,000.
Yeah, it's a very good point, Trevor. Yeah, absolutely. The first scenario, I agree, there'll be some exceptions around leases, and if it's a dilapidated property, that's all they will offer you. And yeah, you're absolutely right. If you do exit the bridge before 12 months or at month 8, they will work out the accrual, what you owe, and that's what you then settle and exit on the end, essentially.
Yeah.
Good. Any other questions from anyone else before I move over to the next slide, please? Okay. So the next one which I've got is second charge bridging for this scenario. Let me give you a very simple example. So Mr. and Mrs. Smith own a residential property which they live in. The property is worth £500,000 and they don't own a mortgage on the residential property. They come to an auction, and what they want to do is to purchase a property at auction, and that property is worth £100,000. Now, when they go to any lender, what they do know for a fact is that the lender will not finance the full amount of the £100,000. They will probably finance £75,000, but Mr. and Mrs. Smith need to stump up £25,000 of their own funds to make up the actual the finance on there. Now they haven't got the £25,000 sitting around, but what they have got is a property which they live in. That property is worth £500,000. It's got no mortgage on there, it's mortgage free. What they can do is to either put a first charge mortgage on that property, or even if Mr. and Mrs. Smith have a mortgage outstanding on their residential, so they may have a £100,000 mortgage on there and the property is worth £500,000, they can get the lender to put a second charge on there to release the £25,000. So in a nutshell, what second charge is the ability to release equity from a property which you might have. It could be a property that you live in. It could be a property which you have on your buy-to-let portfolio just to extract some cash. Now, a lot of investors kind of choose this approach because the money's just sitting around, number one, and they may see this as a better way of preserving cash flow. So rather than dipping into their own savings or money which they have in a limited company. And number three, some lenders may offer them a better rate where they've got the first charge on the purchase, but they're then using the same lender to take a second charge out on a property which they own to extract the cash from there. But in general, that's what a second charge bridge is for. It is a quite common process and an option that many lenders offer. Again, it provides quick access for cash for immediate opportunities. It's flexible, and what you can essentially do, which I've got on the bullet point, which is the second from the bottom, is that if you use a mix of first and second charge, you could potentially finance 100% of the purchase price of the property. So as I mentioned in the previous example, they would use the 75% loan to value or the 75K from the first lender, who's going to help them buy the property. They can then pull this 25,000 that they need from the resi property, and that will make up the 100% that they need, or the 100K for the purchase. As I've mentioned in the previous slide, when you do go with anything around bridging, again, the rates are high, and that's just something to bear in mind on there. But again, that's just something that you would need to consider on a personal level and with help from your accountants if needed.
Sanjay, just a quick question on that second charge approach. I mean, you mentioned the equivalent interest rate on first charge bridging is something like 12% and upwards. When you get into second charge territory, does the effective interest rate, does that go even higher, or is it about the same?
It's about the same. So I've looked at one yesterday for another application. Again, it was first charge and second charge, and they were kind of around the 0.91 mark on there. So they weren't that far off. Yeah. Again, it's horses for courses. It depends on the lender and what approach they take. But some lenders do offer a competitive rate when it comes to first and second charge being done together.
How common is this second charge approach? Is it used quite often, or?
It has been, because the increase which I saw was that when we've had a increase in the space of a year or 2 years, where rates have been stable, and the people have got portfolios where values have gone up, they normally notice that they've got excess equity sitting on those properties. So in some cases, they see this as a better way of unlocking cash, as opposed to dipping into their own savings or refinancing. So for them, it's a quick fix and it's an easier way to do. And it is quite common. I get quite a lot of these inquiries at the moment.
Yeah, it makes a lot of sense. Thanks, Sanjay. That's really helpful. Thank you.
Yeah, I'm just going to add something as well, that this is related to joint ventures. A joint venture is where there's an experienced developer and then generally like a hands-off investor who's typically putting in like the deposit money, sort of part of the renovation costs, and then we're using main bank finance. In some cases, we do these joint ventures where the investor partner coming in doesn't actually have cash available to get into the deal, but they've got equity, for example, in maybe their residential property, and that enables someone to get into property, to own a share of a property. And often sometimes it can be like a more complex project. It could be commercial to residential conversion, using the equity that they have either in their own property or an investment property they have. That's just like as an aside. It's not always necessary to have physical money, and this second charge can be really useful.
One more thing to add, which is important, Trevor, on anything with bridging, is I mentioned that when you go with first and second charge, the lenders will offer you the ability to either pay your repayments on a monthly basis, what they call service repayments, or retained, which means that you pay at the end of your project when you're about to exit the bridge. When you go with service payments, the lender will probably focus a bit more on your personal earnings. And if you've got any commitments in terms of paying other mortgages, costs, school fees. When you go with retained interest, where you pay at the end, some lenders don't do checks on your personal income on there. So yeah, depending on which option you go with, do I pay my interest on a monthly basis, or do I pay it at the end? That yields different outcomes in terms of the checks that the lenders do on there. It's just a minor point, but it's something, which I see quite often, Okay, I'm just going to move on to the next slide. So final one is refurbishment to let. Now, this is a kind of a new product, and I'm seeing more and more of these. So essentially, in what I've been through so far, you'd have a bridging loan, you'd go with one lender, you'll then refinance and look for a buy-to-let mortgage, commercial mortgage. You may then go to another lender on there. When you go to two lenders, that normally incurs 2 sets of arrangement fees, 2 sets of valuation fees. There'll be other fees on there, so you kind of double up on the costs and the fees that you need to do. What some lenders offer is a product called a refurbishment to let, which is that they would give you the bridging finance to start off with for the purchase and the refurbishment, and then they'll do a valuation once you've done all your value add, and they'll then immediately put you on to a buy-to-let mortgage based on the GDV, which is the increased uplift in what you've done to the property on there. Now, the advantages of this is that you have one lender to deal with. When they do the actual valuation, in some cases, they may just do a video valuation or a desktop valuation to see what the uplift is on there. In some cases, you will probably save on your arrangement fees. And also, when you go out of bridge into buy-to-let, they do also offer some very cracking deals when it comes to the buy-to-let mortgage when you move over on there. Again, this one is where you are confident that when you want to do this, you may need to, you may, with an auction, you've got 28 days. With this one over here, some lenders do take more than 28 days to arrange this. So that's just one thing to bear in mind. And the other thing to bear in mind over here is that there will be that second valuation that they perform. So once you've done your refurbishment, they will then do that valuation and they'll then refinance at the higher level on there. The only risk to remember over here is that when you do the valuation, valuations are normally the pain for everyone, because what you think it's valued at may be different to what the valuer thinks. So they may come back at a lower value than you anticipated. But that's a risk with any lender that you take on there. But again, there are a number of lenders which I work with who do offer this, and having refurbishment to let has its advantages also in terms of costs and having everything under one lender, under one umbrella on there. Any questions, please, on this type of product and anything that you may have seen or?
Oh, Sanjay, it's Vatsal again. Sorry.
Thanks.
Is this the same as a bridge to let product? Is that so? I've heard that term, and basically, a bridge then from a lender moving straight onto a buy-to-let mortgage. Is that the same thing then?
It could be, yeah. There's a lot of terminology going around. So I've heard of hybrid products, refurbishment to let, bridge let. My earlier slide was purely talking about a bridging product, where you take out the bridge with a view to then refinancing with another lender on a buy-to-let mortgage on there. With this one over here, you go with the same lender who will offer you the bridge and the actual buy-to-let at the same time on there under one umbrella.
Yeah. Great. Thank you.
This one is not commonplace, but there are some lenders who do offer this. And when I looked at some of the product guides, there are lenders who are now planning to bring out this product in the future, because what they want to do is to give speed of service and keep the costs down for their applicants. So this is an ideal way to consider that. Okay, just going to move on to the next slide. So with any bridging application, look, it can be easy, but it can also be difficult. The next slide would explain what you can do to make things easier for you. But initially, when you go through any bridging application, there's some key steps that normally get followed. The first one is that there'll be an initial call between broker and the client, and that's to determine your goals, your requirements, and to get an understanding about you. What's your credit record like? What's your experience? And what's the type of property that you need funding? The broker will then usually do some preliminary checks where they'll go to the market and come back with some quotations. Once those quotations have been reviewed, if time is of the essence, the applicant will then say, okay, I like quotation B, which is with your lender, and the broker will then pull off a offering principle. Now, why the offering principle is important is that in most cases where you're doing a negotiation with an estate agent, or the auction house may need proof that you've got funds and the mechanism in place, that offering principle letter will probably go a long way. Because some estate agents may want to see this before they accept your bid. In some cases, when you've put down the 10% deposit for your auction purchase, excuse me, the auction house may want to see an offering principle at the same time on there. So it's important that when you do this process, that the offering principle is kind of pulled out pretty quickly, because it has its advantages on there. Once that's been done and the applicant's happy with the offer in principle, and they've then agreed terms with the auction house and the actual or the vendor, a full application gets submitted, which is an FMA, a full application. Application then goes to the lender. The lender will do some initial underwriting in terms of who you are, your credit record. Is the property address okay? Are there any concerns about the postcode of the property? There's no motorways being built or nuclear power plants or anything. And once they've done their checks, the lender will then arrange valuation of the property. And once valuation's been done and local searches are completed, the lender will then provide approval in the form of an offer letter, and they'll get you to sign the offer letter and then release funding. Now, as I mentioned, there are a number of bridging lenders that do work with auction purchases. And in most cases, you can probably go from step 1 to step 7 pretty quickly. So you get the funds within 7 days. So within 28 days. Some lenders do claim that they can do the release of funds within 1 week. Some of them may say 2 weeks, but I think it's all down to valuation. What makes this even quicker is that some lenders will offer desktop valuations depending on the property. So if your property that you want to purchase is a residential property and not semi-commercial or commercial, and it's a low value, say less than £100,000, the lender will just ask the valuer to do a desktop valuation. And that stops somebody going there and taking time doing the valuation. The other thing that some lenders offer is dual representation. For the experienced investors on this call, when you have 2 solicitors involved, yours and the lenders, that always adds time, it adds blockages, and it can slow down the process. When you have one solicitor representing both parties, it does speed things up. So with lenders that offer dual representation solicitors and AVM desktop valuations, that kind of helps to get the whole process moving a lot quicker, in terms of the end-to-end. If this was a buy-to-let mortgage, it will probably take between 6 to 8 weeks because of the thoroughness that they need to go through and the checks and balances that need to perform. But with bridging, best case could be 2 weeks, worst case can be 6 weeks, and for auction, you can probably get these done within 4 weeks anyway. Any questions about the end-to-end process? It was important for me to explain how this works, so you've got a view, step by step, what happens. In between these, there may be other steps, but at a high level, this should kind of give you an idea of what's involved, from day one onwards.
So Sanjay, just on the actual underwriting side of things on a bridge, is are the credit checks more stringent on a bridge or on the refinancing side?
I will probably say they're probably equally important on there.
Yeah.
What will tend to happen is that having bad credit doesn't discount you from having a bridging application. But what I do with my clients is that I will probably pull off your credit record, go through that with you on step number 1, and make sure that we've understood where the banana skins are. And that will then help me determine which lenders I can go to on there. The horrible thing that can happen is that if you don't do that check and you get to step number 4, and then after all that time, we waste a week or 2 weeks, and the lender rejects the application. So good brokerage practice for me is to do those checks from the very beginning when you have that initial call with anyone on there. And as I said, whether it's a buy-to-let mortgage or a bridging loan, the checks are the same anyway. The lender will be strict in what they do.
Yeah. Thanks, Sanjay. Thank
you. So, key success factors. Look, with any process, whether you're buying a car or taking out a buy-to-let mortgage or taking out a bridging loan, nothing's guaranteed. But what is guaranteed is that if you are pragmatic and you do some early checks and balances on your application, you can mitigate a lot of the risks which can happen down the line. Because as I said, what you don't want to be doing is putting an application in, you're working within a 28-day timeline to complete because of an auction purchase, but you realise at week number 2 or week number 3, your application's fallen over because of an admin issue or because your credit record wasn't checked on there. So what I always highly recommend is that the following things are kind of checked. When we work with our clients, we do all of this from day 1. And even before we speak to a lender, we get this documented and we get our applicants to kind of sign this off on fact find documents. But what will be key for me will be things like checking your personal credit record. It could be a small mobile phone bill, which is a missed payment, or you may have a parking ticket. All those things do show up on a credit record. It will not always preclude you or get you not getting an application through, but it's always best to disclose those things to a lender from day one on there. Also, what's important for me is to represent the applicants to the lender in terms of how much experience they have as an investor and landlord. If they don't have experience, that's not the end of the world, but it may limit the broker to see which lenders they can go to represent your case. But for me, putting all of this on a fact-find document is absolutely important. Another key thing is to do a comparison of the property on what else exists on the market. This isn't something for the broker to check, but it's probably more for the applicants. So when you do approach a broker or you're looking at a property, just make sure that you've understood what the valuation is. Is that the valuation from the actual agent, or is it the valuation from a valuation company? And are you able to substantiate that valuation with the property which may be next door or opposite the road, which is similar? The worst thing that can happen is that you overvalue your property when putting in an application, and then the lender's valuation comes back completely low, because what it means is that your LTV, your loan to value, will be affected, and that will then affect what you can borrow and potentially the rate. So it's always best to be conservative, not to overinflate your valuation, and also to be very transparent with the broker on how you've based this valuation on there. Another important thing when looking at refurbishment work, and this is very important for the lender, is that they will ask to see what your schedule of works will be and your milestone plan for the refurbishment work. Now, in reality, when you put in a property for an auction purchase, you may not know from day one what needs to be done. Is it the plumbing? Am I going to reconfigure the rooms? Am I going to do any rendering? Will I need to do the electricity or do the kitchen? But once you've got that property on there, it's important to kind of schedule what you're going to be doing, what the cost is, the milestone plan, and what types of contractors you have in place. Some lenders, especially the ones that offer bridging loans with refurbishment element on there, are pretty strict in understanding what this is. Some lenders who only offer the actual purchase element of the bridging loan may not care on there. They'll leave that with you. But more from a sanity check, for your own check, it's always best to have a plan and to have estimates and budgets and to know who you'll be using to get the work underway on there. Another important thing on there, which is number 5, is what you're doing a permitted development. Now, with anything you do in property, there may be things that you can do without any planning permission, which is permitted. That may include extending the property. It may include doing some internal works on there. In some cases, if you are converting the property from a commercial to resi, or you're doing anything which goes outside planning laws, you will need to get planning permission. If there is planning permission required, you need to be very upfront and honest with this on your application, because planning permissions and applications may not always go to plan. They may be delayed. And as Trevor mentioned very earlier on, what you want to do is to exit the bridge at the earliest opportunity. If you find all of a sudden that you failed a planning application and it goes back into review and approval, that may add months onto your project plan, which means that you're paying on interest for things where you haven't even started the project on there. So it's just important to understand, as part of the application, is what I'm doing light refurbishment, medium refurbishment, or will it be a full-blown development? And if it is a full-blown development, are there any concerns around planning and getting the planning permission in there? And that's vitally important. Final couple of things which are important are your exit strategy. As I mentioned, when you put your application into lenders, they will want to know upfront what you're planning to do after month 8 or month 7 or month 12. Will you be selling or will you be refinancing? And the final point on the slide is number 7, is a bit more about your SPV or your limited company. When you are doing anything in terms of purchasing and development, you will have a limited company set up either as a JV or with a set of directors and shareholders. What the lenders will want to know is how that company's been set up, how is it set up on Companies House, who your shareholders are, and do you have the relevant SIC code and all the paperwork in place to show that that's up and running on there. When you want to get a decision in principle, you don't always need to have a company set up. because you may set the company up at the point you start the work or you're about to complete the process. But when you get the application in fully, you need to make sure that you've got your SPV set up correctly and you've had it checked over properly, because what's bad is setting it up and then all of a sudden changing your directors, your shareholders, because lenders will see changes in company's house, which may ring alarm bells on there. So it's important to keep your company set up stable and not to make any drastic changes at the point your application is going through underwriting and credit. Any questions, please, on the success factors, what you need to consider when looking for finance? Sorry, this was a final slide, by the way. Trevor, we have a very quiet audience today.
Yes, yes. But lots of useful information, Sanjay.
Yep, so yeah, over to you guys. If there's any questions that anyone may have around any of the contents, yeah, I'd be more than happy to answer.
Sanjay, it's Zip here. Sorry. Just on the point you made about the planning side of things. Is it, I mean, often when there's a planning application, you're kind of you might be speculating on the what you can lift the NGDV of a property to, right? Until the planning's actually secured, right? But once the planning is actually secured, do lenders look at that, particularly if the NGDV is now
A lot more.
higher or uplifted much more than the property was valued before the planning was secured, if that makes sense, right? Because
Yeah, so
yeah, imagine you can only borrow a certain amount. Sorry, I'm just trying to get my thoughts in order, Sanjay, but I think you know what I'm trying to think. Yeah. Is that a thing where potentially by securing the planning, you've actually raised the NGDV of your project more than you thought you would? And you can secure financing against that new raised GDV?
good question. Yeah, so ideally what lenders want to know is if you've got the planning in place already, which you probably wouldn't do anyway until you've secured the property on there. But if there is a situation where you were planning to refurb, but then you decide I'm going to build an extension which is more than 6 meters out to increase the actual property configuration and the value, then yeah, lenders will probably look at that. In most cases, lenders just want to know what you're going to be doing just to exit the loan. They don't really care about the GDV. As long as they're confident that the original GDV can be met. If there's even a bigger uplift, I don't think they're going to be that fussed about it. But if you are going to be using the same lender and you're going to exit their bridge and then move over to their buy-to-let or commercial product, then yeah, they may want to know why. Now, in some cases, why this is important is that if you realize all of a sudden that you need to put planning permission in place, and that may add risk to your exit strategy. So you may not be able to complete until month 11 or month 12, and you may need to prolong the project, then you may need to discuss that to increase your term for your bridging loan. In some exception scenarios, lenders may allow that on the recognition that you're actually doing a bit more, but that bit more will increase your overall GDV and what you're exiting on there.
Can you ever get a bridge to secure a property on the understanding that you're going to be putting in planning? Obviously, there's a risk to the planning, but
yeah, you can. Yeah, so some lenders do recognise that you are going to be purchasing this. There's an element of getting permission, whatever it is. But what you would need to do is to show that on your milestone plan and schedule of works. So what does it mean in terms of you delivering the end projects on there?
right, got it. Yeah,
Yeah.
that makes
That
sense.
plan is important. Yeah, I get a lot of applications coming in. They'll have what I call a fag packet plan, where they haven't got things laid out properly, but it's not even readable in most cases. And I always say to the applicants, look, I can't send this to a lender. It just looks unprofessional, and their underwriting will just reject it. So it's important just to show what that planning element is, and what does that mean for the rest of your delivery on there. Does that help?
Yeah, I'm just trying to I think you've answered my question. I was just looking at a scenario where um you are intending to develop, but you haven't you recognize you've got to put a planning application in, but you want to secure the property,
Yeah,
right? In effect purchase it. So obviously there's a lot of risk there,
there is.
but you may have no choice but to raise financing to secure property or the bit of land or whatever it is, right? Um, and obviously you won't have concluded on your planning application, right? So your plan is part of your plan is to submit planning, right? But unless you secure the property
You can't get the planning.
in some way, right, i.e. with a bridge, you're not even going to get past the first post, really.
Yeah, what I've seen on the market is that you may have the initial part to purchase the property. What you then realise is that as part of your planning, you need to do a lot more development. It's not just refurbishment, but it needs planning permission. It will need a lot more contractors. So a lot of lenders do offer terms which are more than 12 months to recognise the development element on there. So what they'll probably have is the first tranche, which is your purchase bridge, to purchase the purchase to pay for the purchase. They'll then offer you a second tranche, which is to then do the development work on there. So yeah, the bridge doesn't have to be for 12 months. It could go beyond 12 months, but there are products available where you've got the purchasing element and then you've got the development element, which could be like a heavy refurbishment bridge or a development bridge or a development loan to cover the rest of the work on there. And yeah, it can go above 12 months. So there are lenders which do offer products which go beyond 12 months for that very scenario.
Yeah, got it. Thank you.
Yeah.
Right. Are there any other questions? Any questions from the silent people? Right, well, we're going to wrap up there. Thank you, Sanjay, for an excellent overview of borrowing and the different possibilities. And we can this recording will be available probably tomorrow on YouTube, so you can come back and have a look at it and share it with other people.
Now I was going to say, Trevor, if anyone's got any questions, if they want to just send them across to either one of us offline, more than happy, to answer anything ad hoc, if that helps,
Yeah, Sanjay's actually looking after a number of borrowing for some people that for whom we've been finding properties. Yeah, so we've got a few deals in progress. So yeah, if you're looking for finance, let me know. We can get you in contact with Sanjay.
Yeah. Thanks, Sanjay. Really clear.
No, thank you, Sam.
All right, well, have a good evening, everyone.
Enjoy the sunshine, everyone. Yeah.
Thank you, Sanjay. Thank you, Trevor. Bye.
Yeah, bye.
Thanks, well, thanks, Bill.